Good morning, good afternoon. This is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Today, we've got two special guests joining us. Hopefully, we've got one already here on the call. So, Brett Gibbs, who's our biofuel and energy analyst, first time joining. So, we're excited to hear what he's got to say. We also are anticipating that our ESG colleague Rob Boff will be joining us, although he's not here yet. So let's see if he actually figures out how to get on. And then we've got regulars over in London. We've got Patricio Alvarez, where it's around the same temperature in London as it is in Florida, and we've got Fernando Valle in 731 Lexington. Apparently very cold there today. And I see our colleague Rob Boff has just joined. So I want to thank you all for being here today. We have a lot of very interesting events happening in energy space at the moment, and particularly, I think you're going to see a lot of headlines dominated by the COP28 climate conference, which is taking place in Dubai this year. And so, Rob, we're going to put you on the spot. We're going to come to you first because COP28 is always an interest, or the COP meetings in general always are an interesting time to think about that intersection of the energy world and the policy world. And I think kind of different minds on kind of how to interpret what's going on there. But what do you make of the COP meetings? Are they sort of just gatherings where people kind of get together and talk about things and nothing really comes out of it? Or do you think we're going to see some meaningful advancement on what the political class of the world thinks needs to happen with emissions in the energy sector?
Yeah, I mean, I guess I'm a little cynical of all this. I would say that there's always these kind of big discussions about high level, what are the trends, what's everyone focused on? It becomes such a big deal. Um, and then kind of a month later, you hear nothing else about it. So last year, if you remember, I know it's hard to remember because it hasn't come up much since, but everyone talked about loss and damages. Basically, how do we help the global south move along in the transition? The fact is a lot of the physical damages caused by climate change are impacting island nations that don't themselves have a lot of emissions. So is it incumbent upon the some of the historical emitters to really fund this? And that became a big deal. There was a lot of toe dragging, and finally at the last minute there was this big compromise, this big solution, and then again a month later I haven't heard anything about it. I mean, I actually had the chance to visit a couple of island countries earlier this year for to attend climate conferences, and really there was almost nothing came out of this agreement that everyone made such a big deal out of. So the short answer is um, unfortunately not a ton comes out of it, although you do see a lot of these kind of big industry driven initiatives from the private sector, and I think that's kind of a good thing.
Can I get your latest read on the scientific discussion? Because in many ways, I think we've already passed 1.5 degree emission scenario based on most people's understanding of how that would work. And in theory, we're going to land at some level higher than that. I think the most extreme scenarios are on the upper end are also off the table, but kind of what does the trajectory of emissions and energy sector look like based on kind of where the consensus is at the moment?
Yeah, it seems again it's there's still a landing spot to get there, but it's very, very tight. I think basically, the world has to stop using oil by 2030 to really get there. And the flip side of that is also ramp up low carbon energy sources very, very quickly. So it's still technically feasible, but it's very unlikely we're going to get there. That said, I think you know, I, I think there's still a recognition that a lot of the a lot of the investments still need to be made to prevent things from getting worse than that. So, even though, 1.5 above 1.5 degrees is bad, it could always get worse, right? So, there's still a lot of work to be done to get to 2 degrees or worse.
Okay, so I don't think we're going to stop using oil by 2030. Even 2050, I think there's still going to be a fair amount of oil use, as we'll probably hear from some of the others on this call a little later. But first, I want to swing over to Brett. So, Brett, is first time joining. Don't want to put you on the hot seat to sort of weigh in on COP28 unless you want to. But I think biofuels have often been a part of the sort of emissions climate solution conversation that's out there. And this is an area that you're looking after for BI. So I'd be curious to hear your general characterization of this space. And do you think policymakers are really supporting biofuels at the moment? Is there some kind of regional differentiation there? Kind of where are biofuels in the mix?
Yeah, thanks, Rob, and thank you for having me. So, from looking at the biofuel space, a lot of our focus leading into 2023 was on renewable diesel. And the reason behind this is it's been the growth vector for biofuels in general. In the US, just giving you some numbers, in 2021, we were producing about 55,000 barrels a day of renewable diesel domestically. 2022, that jumped to 95,000 barrels a day. And in 2023, we're scheduled to hit about 160,000 barrels a day. So it's material growth there, and it's key in driving the carbon credit prices and markets. And I think really biofuels in general was at a crossroads entering 2023. And our thesis going into it was that in the US specifically, the way that demand for biofuels is set is on a policy level. So in the US, the overarching policy is the Renewable Fuel Standard, and the EPA in this year set volume targets through 2025. And what it was is essentially continued growth, but not growth at the rate that the industry was expecting. And as a result, our call was that there was a lot of wiggle room essentially within renewable diesel margins for that to compress. And so we've seen margins since the EPA announced volume targets in June fall from about $2.25 to about $1.25. And really kind of what that means next is we pace up all the projects that are scheduled to come online during that time frame, and we see almost a cap now on renewable diesel margins as a result, because we're kind of it's no longer growth at all costs type of scenario. So as a result, the view is it's kind of this cap on the margin environment. But again, the way that the policy works is there's cushion where we believe there's not necessarily going to be a total collapse.
Oh, interesting. Can I get you to weigh in, if you have a view on it, on the sustainable aviation fuel piece of it? And I would note, I believe it's just yesterday or day before, I think it was Virgin Atlantic. I saw some headlines that they had done their first transatlantic flight with 100% SAF. So is this a big thing? Are your companies focused on SAF, and where does it fit versus ethanol, biodiesel, et cetera?
Absolutely. So I think the primary focus in the role of biofuels in general is to decarbonize hard to abate sectors, right? And within renewable fuels specifically, the focus is on drop-in solution, particularly in industries like heavy duty trucking, maritime or marine fuels, and the big piece now that's gaining focus is sustainable aviation fuel. And I think policy is steering in that direction, and that was previously the big roadblock. Within the IRA specifically, there's now a tax credit for sustainable aviation fuel, whereas traditional road-based diesel would get about $1 a gallon in federal tax credits. For sustainable aviation fuel now, you can get up to $1.75. So that was bridging the incremental costs to get there, as well as you're seeing more states adopt their own tax credits in the US, which is helping bridge that cost divide and also accelerate growth. So you're seeing a lot of the biomass-based diesel producers add capacity that allows them the flexibility to produce sustainable aviation fuel. And this goes into creating more durable margins, as well as the new incentives are bridging the cost divides that allow different technologies like ethanol to jet to become economic. And you're seeing some developments there. All in all, it seems like sustainable aviation fuel from a policy perspective has the most durability, and I think that's where it's steering some investment decisions.
Fernando, I want to swing over to you on biofuels. There was a well-known partnership quite a few years back between Exxon and Synthetic Genomics focused on the drop-in biofuel piece, but I haven't heard much about that in quite some time. Maybe it's not even a thing anymore, but for the integrated oil companies, what are they thinking on the biofuel side of the equation?
The famous algae-based biofuels. You haven't heard much of it because Exxon scrapped it. So it's no longer something that they're investing significantly on. But on the other side, Chevron acquired Renewable Energy Group a little over a year now, who is a big biodiesel and renewable diesel producer. So they are a lot more advanced in the renewable fuel position than Exxon. Exxon's chosen instead to go towards the carbon capture route, especially after the IRA gave a lot of benefits to carbon capture, $45 per ton of incentives. So they went out and bought Danbury Resources, primarily because Danbury has a CO2 pipeline that goes around two of the main hubs which Exxon is developing, and a lot of its infrastructure. So they have one near Houston and then one in Louisiana, where Exxon has large refineries and is signing up other high emitters in the region. Who's really been investing in renewable fuels, though, on my coverage side, and where Brett has done a lot of work, is the refiners. So Valero, one of the largest producers of their partnership with Darling Ingredients, Diamond Green Diesel, Brett covers, and then Marathon partnership with Neste, also under Brett, and Phillips has a plant they're trying to get off the ground across from Marathon's and Neste's, and PBF has a partnership with E&I in Louisiana, and CVR Energy has a small facility in the famous Tiger King refinery in Wynnewood, Oklahoma.
Okay, thanks, Fernando. Patricio, I want to swing around to you. I know liquid biofuels have almost no role in the power sector historically, but biomass, wood chips, that kind of thing is a thing. Drax there in the UK, well-known entity for participating in that. Is biomass in the power sector, biofuels in the power sector, a thing? And also just, I'm curious on the COP conversation as well. Do your companies even care about something like that, or is it much more driven by what the individual sort of country, states, regions are up to that matters?
Yeah, so on the first on the first piece, I think the pegging order for capital allocation would place dispatchable power sources such as like biomass or burning diesel or oil or wood chips like Drax does. That would put them fairly low on the pegging order. Probably flexible gas generation is on top of that, like has a bigger role, and I'd say 80 to 85% of what utilities spend their money on now, it's either renewable power generation, so adding new capacity of wind and solar, and now batteries a bit more than before. And the other sort of 50% of that 80%, if that makes sense, the 40% goes to transmission and distribution grids. So overall, not a huge role. Drax has been involved in these sort of questionable practices from their environmental perspective. Question if those are really renewable sources or not, since they're burning wood chips and that does produce emissions, but there's this whole argument. But yeah, so short answer is not really. There isn't much investment going into that. And in terms of the COP28, that is definitely, at least from a marketing perspective, it's a great sort of milestone for a lot of my companies, for a lot of the companies we cover here in Europe. So you have your Iberdrola, your Enels. These are sort of amongst the largest renewable power developers in the world. Despite the fact that they've been slowing investments into the sector over the past 18 months or so, they're still huge players in that sector. So yeah, I think that would be from that angle that they would use the COP. If the COP produces or results in more targets, let's say more renewable ambitions, more climate, yeah, or stringent or more stringent emissions targets for select jurisdictions, our companies are probably going to try and move towards that direction, because by and large, policy and regulation is what's moving the needle in renewable investment. So the COP can be a good signpost for that.
Okay, thank you, Patricio. I want to call some attention to a very interesting survey that our colleagues at BN have run. And if you haven't seen it, just shoot myself or any one of us email and we can get you the full survey. But it about 620 people were surveyed, I believe mainly our clients, and number of questions that were asked relate to this intersection of energy and climate. And the first question I thought was fairly provocative. So, will rising temperatures and more frequent climate disasters affect portfolio values over the next 3 years? And 42% said yes, and I'm trying to figure out how to deal with it. 24% said yes, and I'm making adjustments now to reflect that. So more than half were a yes to that question, which I find pretty surprising. 34% were no, I think talk of climate risk is overblown. So, Rob, given you're one of our resident ESG experts in the BI family here, what do you make of these survey results? Does it align with how you think ESG investors are approaching the topic? I was certainly surprised that well over half the investors did really seem to think this is a real concern that they need to be thinking about.
Yeah, I mean, I guess that level doesn't surprise me, but the timing kind of does. The 3 years seems very short term, because yeah, I mean, certainly we are seeing, every year you hear about intense storms, but I think, we always try and caution people, and I know it's hard, especially when you're dealing with hedge fund clients, to say, focus on the longer term, right? Because anything, you could certainly have a 3-year stretch where there's more limited hurricane activity. That doesn't invalidate climate change in any way. It's just, 3 years seems like a short time period to me, but certainly I'm not surprised that, I mean, there's a lot of money being spent there. So, aside from the risk side, there's the opportunity side, right? I mean, Fernando mentioned kind of repositioning portfolios on carbon capture. Certainly Exxon isn't the only one, and there's a lot of, a lot of money to be made from some of these investments that can benefit from the IRA, or maybe some of the other incentives that are going around globally. Certainly carbon pricing, and circling back a bit to COP, that's something that expect to come up a lot in COP this year, is trying to figure out a global standard for carbon offsets and how to price them. And certainly that's a really key component to kind of bringing an externality and more internalizing it, and that having a more direct impact on P&Ls, whether it's in the short term or longer term. So I do think there's a lot of clients that do start to think about, how do I position the portfolio? And then unfortunately you have things like drought, impacting things like commodities prices. So there's definitely aspects of climate change that, as an investor, you should be thinking about, whether it's in a 3-year time period or more a 10-year time period.
Brett, I want to ask you a similar question. Just given you look after the biofuel names, there's obviously this climate component there. There's a weather component related to crops and agriculture. But what's your sense? Are the names that you look after, are is a lot of the if you look at the holdings, is there a lot of ESG type investors that have been attracted to the biofuel space, or do you have a lot of overlap with oil and gas? Kind of, and what kind of vibe do you get from folks who are interested in the biofuel names?
Yeah, certainly. Most of the pure play or as pure play as you can be renewable fuels names like Darling Ingredients, Neste, et cetera, do have many ESG focused investors, and you'll see that reflected in their holdings versus traditional oil and gas. But I also think it's a ESG vector for maybe the refiners or integrated oils like Fernando was mentioning in Fernando's coverage, right? So you look at Valero, Marathon Petroleum, Exxon, et cetera, a lot of their low carbon initiatives include renewable fuels, and maybe that's to tap into that space too.
Okay, Fernando, I want to come over to you for another question that was in the survey, which I think is interesting. So, which will be the best equity investment in 2024? In a few categories. The first one is solar, wind, and batteries all combined. About 15% of folks highlighted that. EVs, 13%. Miners of critical minerals, so metals and mining, 38%. Single biggest cohort picked that one, and then none of the above, 34%. I'm gonna assume that's the oil focused people, maybe, or who knows, maybe it's tech people. No idea. But Fernando, what do you make of all this discussion? Biofuels, COP28. How's 2024 shaping up for the traditional oil and gas business? Is it gonna be a good year, or do we have headwinds? You know, where's the oil macro at?
So I think everyone has headwinds right now, but I think among all those listed and some others, uh, traditional oil and gas still sits very well. And the biggest reason for that is really interest rates. I mean, at the end of the day, that's what governs most of these investments. And Patricio can tell you about the issues on solar and wind, and you, Rob, obviously, of financing with 6-7% interest rates. So if you believe that interest rates will be cut in Q1, like Bill Ackman, which I'm not on that camp, then perhaps you are on the side of solar, wind, and EVs. But it becomes really hard to finance new vehicles at 6-7% right now after years of sub 3%. It becomes very difficult to finance projects that have a return on capital of 6% if they execute with interest rates at these levels, as we're seeing with Ørsted and with BP and Equinor. And it becomes very difficult to finance rooftop solar at those rates as well, especially since the consumer is struggling. What sets most of big oil and refining apart is the balance sheets have really come a long way over the past 3 years. And I think the underinvestment in supply will show up beyond 2024, probably not in 2024, which is why we're not particularly bullish in the sector. But beyond 2024, we think the underinvestment starts to show. We haven't really done any exploration for over a decade, and U.S. shale is still growing, but with this wave of consolidation, cost inflation, and the interest rates increases themselves, we think that it will lose a little bit more steam, and then we'll see that gap emerge as we have to make up for ongoing depletion.
Patricio, I want to swing over to you with a similar line of questioning. I think European gas demand has been pretty anemic. How do you see the gas supply demand balance shaping up for 2024? And I think you've got a new fair value model and no doubt that maybe you can speak to as part of that.
Sure. So on the supply demand balance, yeah, I think things are looking a bit looser for 2024. So we've again, weather has been very well timed, or has been very kind to the region. We entered the heating season with storages virtually full, so 99% full. They're still about 98% full right now. Which we're already almost halfway through the first segment of the heating season, and still at record levels in storage. Otherwise, demand for LNG in Asia has disappointed. It has picked up recently, but it has disappointed relative to our previous expectations. And also, like you mentioned, European domestic gas demand is very weak and has remained very weak since the decoupling from the Russian gas supply via pipe. So I think those are sort of laying the grounds for us to have a more bearish approach or a more bearish view over 2024 pricing. Risks to our view would be a stronger than expected economic recovery in Asia, which would prompt higher LNG imports in China. But we do see that as having limited potential given the rise of coal production there and new additions of coal capacity there. So there's not a lot of upside risk aside from what we think is peripheral risks to supply. So meaning security risks, perhaps tied to the conflict in the Middle East, or perhaps the cease or the cut of the remaining Russian piped gas flows. So those perhaps would complicate things, but that would just result in I think short-lived price volatility, given that the fundamentals are to the downside. I think a good soundbite would be that European gas demand in 2023 will be, according to our estimates, will be roughly 20% lower than what it was in 2021, and we only see maybe 2 to 4% upside for 2024. So it's a very weak recovery, given the economic sentiment remains very low. Industrial production is anemic, with prices still elevated. So prices at 40 euros per megawatt are still twice as much as what they were before the war in Ukraine, and are also maybe 4 to 5 times what the gas prices are in the US. So gas demand is very weak, mainly because of prices.
Okay, very provocative, Patricio. Time always flies here. I feel like we're just getting the discussion going when it's time to end. Look, one thing, let me just call your attention to. We have a number of events taking place in Dubai around COP28. Our colleague Salih Ilmaz, who's normally on this call, a regular, he's based there. He's going to be speaking in some events. So if you're there, certainly reach out to Salih. But Adeline Diab, I believe Eric Kane from the ESG team, I'm sure many other Bloomberg people are on the ground, and almost daily we've got something going on. So if you happen to be over there, or even if you're based there and you want to participate in some of those discussions, shoot any one of us an email. We'll get you pointed in the right direction for that. Now, with that in mind, let's just do a quick round robin here on COP28, and I think the question that I'll pose here would just be: there have been some headlines on the terminal talking about the idea of peak emissions, and there's a group called Climate Analytics that says there's a 70% chance that emissions peak this year, here in 2023. And so, Rob, we're going to start with you. What's your sense? How close are we to peak emissions? And are the conversations occurring at COP really going to fundamentally affect that outcome in any meaningful way?
I mean, I've covered the oil industry long enough to know not to call the peak in anything at any point. So, I think certainly there's a lot of kind of innovation out there, whether it's, efficiency, whether it's kind of, pulling demand away from higher carbon to lower carbon, whether it's carbon capture. I mean, there's certainly the tools there to start reducing emissions, but I think there's always kind of, there's always a supply shock, a demand shock, some kind of shock, right? That will, that could certainly alter the trajectory. So I think we could be close, but I'm not dumb enough to make that call right now.
Okay, Fernando, I know I've asked you this question before, but it is interesting because when you talk to some of we talked to Will Harris, who covers the European oil majors, they're all talking about managing down their emissions portfolio. They've got plans on how to do that over the coming decades. But what do you make of it? Are we anywhere close to peak emissions?
I mean, you just heard Patricio say that industrial activity in Europe is down 20%. So if to be correct on the emissions, you'd have to assume that that never recovers, and we're going to, in other parts of the world, also don't recover from their current malaise, economic malaise. So I think there's a 70% or higher chance that they're wrong on calling now the peak.
All right, cool. We'll take it. Patricio, over to you. I know most of your companies have been trending down for probably quite a while, actually, in terms of their net emissions. But what do you think? Are we anywhere close to the peak?
Yeah, it's hard to say. I agree. So I have to give you a half answer there, I guess. So yeah, gas demand is concerningly low. I don't think that being at minus 20% versus 2021 is sustainable. Though there are pockets of demand that perhaps won't come back because some of those energy sort of conservation. That energy conservation has come through the increase in renewable capacity. And that is debatable because that eats into coal-fired generation as well. But overall, at least in Europe, I wouldn't call, I can't call it peak because of the same reason that Rob gave. I don't think it's smart to lay myself out there, but we're close to the peak perhaps in Europe. Just given that the policy here is at a more mature stage, carbon pricing is working. It improves the economics of renewable power generators, even if they come from hydro sources. So perhaps in Europe we're close. I'd say on a global scale, perhaps a bit further out than what most think. Just given the fact that a lot of the growth in energy consumption will come from developing economies, and things are a bit a bit tougher, a bit more mixed for the renewables there. So.
Okay, very good. So Brett, a slightly different angle for you. I think everyone who's on this call is probably very attuned to CO2 emissions from using fossil fuels, but a big portion of overall greenhouse gas emissions actually is agriculture, right? And so I think there's a lot of thinking that we have to change the kinds of foods we eat and this kind of stuff. And you're always seeing these headlines about, maybe Americans have to eat less meat. Who knows? I don't know what to make of any of that. But how important is agriculture just generally in kind of thinking about the concept of where emissions are at?
Yeah, it's an interesting question. From a biofuel specific angle with agriculture, right? The premise of why agriculture is a feedstock into renewable fuels is it absorbs atmospheric CO2, right? And then you process it and that sort of thing goes into the actual carbon intensity or the carbon emissions in the life cycle stage of using agriculture. So I think that's an interesting focus. A lot of what is being done now too is how do we measure life cycle emissions, particularly land use and that sort of thing, to assign a score to fully be able to understand per bushel of corn, for instance, what the associated CO2 is. I guess I want to also address your earlier question too, within the biofuels angle specifically, if we've reached peak emissions. And the thing that I always like to bring up is where we're at from a renewable fuels perspective and just the overall percentage of road fuels as it is and some of the lingering limitations to that. So a majority of biomass-based fuels rely on fat oils and greases. And in the US specifically, we can only support about 362,000 barrels a day of fuels. And so really, really small portions still. And there's a long way to go until we can materially dent and absorb, 20% of road fuels cost effectively. So I think you can use that little tidbit too in assessing if we've reached peak emissions yet.
Okay, very cool. So I want to thank everyone for joining today. Very interesting discussion. If you have any follow-up on the in-live survey that our colleagues conducted or how to join some of our events that are taking place at COP, we're all happy to be ambassadors and help you get that information. Otherwise, make sure to check out all of our research, BI Go, and check out the myriad of things that we are offering analysis and research on. So have a great week. We'll reconvene next Wednesday. Look forward to being in touch. Take care, everyone.